Freedom isn't free. This phrase has appeared on bumper stickers and memorial walls across the Western world for decades. It was always meant as a moral statement, a reminder that liberty carries a cost measured in sacrifice. But starting in February 2026, that phrase acquired a second meaning, a financial one, because now freedom has an interest rate. On February 13th, 2026, defense ministers, heads of state, and intelligence chiefs from across the Western Alliance gathered in Munich, Germany. The Munich Security Conference has been held every year since 1963. It is the single most important gathering in the Western security calendar, not because formal decisions are made there, but because the conversations held in its corridors shape everything that follows. The 2026 edition arrived under unusual pressure. European defense budgets, despite years of increases following Russia's 2022 invasion of Ukraine, were still falling short of what military planners described as minimum operational requirements. The NATO commitment that member states would spend at least 2% of their gross domestic product on defense, agreed formally at the 2014 Wales Summit, remained unmet by a majority of alliance members heading into 2026. And in Munich, a growing faction of defense ministers began arguing loudly and in public that 2% was no longer sufficient. The figure being discussed was 3.5%, nearly double the existing commitment. To understand what that number means in practice, consider the arithmetic. Germany's GDP in 2025 was approximately $4.5 trillion US dollars. 2% of that figure equals roughly $90 billion per year in defense spending. 3.5% equals approximately $157 billion. The gap between those two numbers, $67 billion per year for Germany alone, has to come from somewhere. France faces a similar calculation. So does Italy, Poland, the Netherlands, and every other NATO member. When you aggregate the total shortfall across the entire alliance, the number that emerges is not in the billions, it is in the trillions. And every government in that conference hall knew that existing tax revenues and peacetime budget structures could not cover it. The solution that began circulating, not in official communiques, but in the quiet conversations between formal sessions, was a financial instrument with deep historical roots, a defense bond. Or, in the language being used in Brussels and Berlin in early 2026, a joint security bond. The concept is straightforward on its surface. When a government cannot fund an urgent expenditure through taxes or ordinary borrowing alone, it issues a specific category of debt instrument, a bond, targeted at its own population. Citizens and institutions buy these bonds, effectively lending money to their government in exchange for a promise of repayment with interest over a defined period. The government uses the proceeds to pay for what it needs. In wartime, these instruments have historically been called war bonds. In 2026, the preferred branding was different, but the underlying mechanism was identical. The most instructive historical parallel comes from the United States between 1941 and 1945. After the attack on Pearl Harbor in December 1941, the U.S. government faced a financing problem of almost incomprehensible scale. The cost of mobilizing, equipping, and sustaining the largest military force in American history vastly exceeded what peacetime tax revenues could provide. The answer was the war bond program, formerly known as Series E defense bonds. Between 1941 and 1945, the U.S. Treasury sold approximately $185 billion worth of these bonds. Adjusted for inflation, that figure exceeds $2 trillion in today's purchasing power. The campaign was comprehensive. Hollywood studios produced short films promoting bond purchases. Major celebrities toured the country at bond rallies. Department stores set up bond booths. Employers offered payroll deduction programs so workers could buy bonds automatically from each paycheck. They were making a statement about whose side they were on. The bonds tied the civilian economy to the military effort in a way that speeches and posters alone could not achieve. Britain had done this before America, and more extensively. During the First World War, the British government issued what became known as war loans, beginning in 1914 and continuing through the entire conflict. It is a data point about the long shadow that defense borrowing casts across an economy. The financial obligations created by one generation's security decisions can persist across multiple generations of taxpayers who had no role in making those decisions. In 2026, the proposal being discussed in European capitals carried several distinguishing features from the World War II model. First, the scale was unprecedented in peacetime. No conflict had been formally declared. No enemy had attacked NATO territory, yet the proposed borrowing was being sized as if for a major war. Second, the structure being discussed involved a degree of pooling, the idea that the EU or NATO as collective entities might issue bonds jointly, with member state revenues providing the backing. This concept had been tested once before, in a very different context. During the COVID-19 pandemic, the European Union issued its first ever collective debt instrument, the Next Generation EU Bond Program, to fund economic recovery across member states. That program raised approximately 807 billion euros and was considered, by most assessments, a financial and political success. Defense bond advocates in early 2026 pointed to Next Generation EU as proof of concept. If Europe could collectively borrow to fight a pandemic, the argument went, it could collectively borrow to deter a military threat. But this is where the economic analysis becomes considerably more complex and considerably more consequential for ordinary citizens. There's a concept in macroeconomics called crowding out. It describes what happens when government borrowing on a large scale competes directly with private sector borrowing for the same pool of available capital. The logic runs as follows. Capital, money available for lending, is not infinite. When governments issue large quantities of new bonds, they are essentially entering the market as very large borrowers competing with businesses seeking loans for expansion, home buyers seeking mortgages, and entrepreneurs seeking startup funding. Governments have a significant advantage in this competition. They are considered lower-risk borrowers than most private entities because they have the power to tax and, in some cases, to print currency. This means they can attract capital by offering interest rates lower than what private borrowers would need to offer. But when government borrowing surges to the levels being discussed in early 2026, even that advantage begins to erode. The sheer volume of new government bonds coming to market pushes up the interest rate the government itself must offer to attract buyers. And when government bond yields rise, they pull up every other interest rate in the economy. Mortgage rates rise, corporate borrowing costs rise, car loans become more expensive, student loan rates increase. The entire cost of debt across the economy shifts upward in response to the government's expanded borrowing. This is crowding out. And in early 2026, with sovereign bond issuance in Europe accelerating on multiple fronts simultaneously, the signal was already visible in the data. The yield on 10-year German bonds, considered the benchmark for European sovereign debt, had been rising steadily through late 2025 and into early 2026. The yield on equivalent UK gilts showed a similar trajectory. French and Italian sovereign yields, already carrying a risk premium above the German benchmark, moved higher still. Bond markets were pricing in the expectation of significantly more government borrowing, and they were demanding higher interest rates to compensate for the increased supply. For context, consider what a 1 percentage point increase in mortgage rates means for a household. A family buying a €300,000 home with a €250,000 mortgage at 3% interest pays approximately €1,054 per month. At 4% interest, that same mortgage costs approximately €1,194 per month. The difference is €140 every single month, €1,680 per year, extracted from that household's budget by an interest rate movement driven, at least in part, by defense spending decisions made in government buildings hundreds of kilometers away. Multiply that effect across millions of homeowners, renters whose landlords face higher financing costs, and businesses with variable rate loans. The aggregate economic impact becomes very large, very quickly. There's a second mechanism through which defense spending reshapes the civilian economy, and it operates through a different channel entirely. It is called fiscal dominance. Fiscal dominance occurs when the scale of government debt becomes so large that it begins to constrain the behavior of central banks. Under normal conditions, central banks, the European Central Bank, the Bank of England, the US Federal Reserve, operate with meaningful independence from government fiscal policy. They can raise interest rates to control inflation, or lower them to stimulate growth, based primarily on economic conditions rather than government financing needs. But when sovereign debt reaches very high levels, that independence becomes harder to maintain in practice. If a central bank raises interest rates aggressively, it increases the cost of servicing existing government debt. Governments with very large debt loads face higher annual interest payments. In extreme cases, this can create fiscal stress, a situation where the government's interest obligations crowd out spending on everything else. The historical case study that economists most frequently reference is the United States in the years immediately following World War II. By 1945, U.S. federal debt had reached approximately 119% of GDP, a level not seen before and not seen again until very recently. The Federal Reserve, under what was called the Treasury Accord arrangement, effectively agreed to keep interest rates artificially low to help the government manage its debt servicing costs. This arrangement held from 1942 until 1951, when the Fed and Treasury formally negotiated a new understanding that restored central bank independence. During that period, the Fed's primary concern was not inflation control. Its primary concern was keeping government borrowing costs manageable. The result was a prolonged period of financial repression, where real interest rates adjusted for inflation, were persistently negative. Savers holding government bonds were, in real terms, slowly losing purchasing power. The government was, in effect, inflating away a portion of its debt burden at the expense of bondholders. This is one of the mechanisms through which large wartime debts are historically resolved, not through explicit default, but through inflation that gradually erodes the real value of fixed obligations. The scenario being discussed among European economists in early 2026 was whether a similar dynamic might emerge. If European governments issued several trillion euros of new defense bonds over the next 5 to 7 years, and if the ECB found itself increasingly constrained in raising rates due to debt sustainability concerns, the result could be a prolonged period of above-target inflation combined with below-market real interest rates. This is the scenario economists call financial repression. And its primary victims are not governments. Its primary victims are ordinary savers, people holding cash, bank deposits, or fixed-income investments, who watch their purchasing power erode while technically losing nothing on paper. Now consider the defense industry dimension of this story. The capital raised through defense bonds has a destination. It flows to companies, specifically to the companies building the weapon systems that European governments have committed to purchasing. In the United States, the primary beneficiaries of any surge in NATO defense spending are well established. Lockheed Martin, the world's largest defense contractor by revenue, produces the F-35 fighter jet, the primary next-generation aircraft being procured across NATO. In 2024, Lockheed reported revenues of approximately $70 billion. RTX, formerly Raytheon Technologies, produces the Patriot missile defense system, Stinger missiles, and a range of precision munitions that European governments have been ordering at accelerating rates. In Europe, the comparable companies are Rheinmetall of Germany, BAE Systems of the United Kingdom, and Thales of France. Rheinmetall, which manufactures the Leopard tank and a range of artillery and ammunition systems, saw its share price increase by more than 300% between early 2022 and early 2026 as European defense orders surged. BAE Systems, which builds frigates, Eurofighter jets, and a range of naval and land systems, similarly experienced a sustained period of elevated stock performance as defense budgets expanded. The financial markets were not simply reacting to current conditions. They were pricing in the expectation of defense spending that had not yet occurred, spending that would be funded, at least in part, by the bonds being discussed in Munich. This creates an interesting asymmetry. Defense company shareholders benefit from rising defense budgets. But the cost of those budgets, through higher taxes, higher borrowing costs, and reduced public investment in other areas, is distributed across the entire population. The gains are concentrated, the costs are diffuse. This is not a new observation. President Dwight Eisenhower made essentially the same point in his farewell address to the nation in January 1961 when he warned of what he called the military-industrial complex. His concern was not that defense spending was unnecessary. His concern was that the institutional relationships between government, military, and industry had become so entrenched that they would generate their own momentum, independent of actual strategic need. In a speech from 1953, he put it more directly. Every gun that is made, every warship launched, every rocket fired signifies, in the final sense, a theft from those who hunger and are not fed, those who are cold and are not clothed. Those words carry a different weight in 2026, not because the strategic circumstances are equivalent, but because the underlying tension between military spending and civilian welfare is structurally identical. There is a third dimension to the 2026 defense financing story that receives less attention than the bond mechanics, but may prove more consequential over time. It is the question of what does not get built when resources flow toward defense. Economists call this the opportunity cost of military spending. Every engineer working on missile guidance systems is an engineer not working on medical devices, renewable energy, or semiconductor fabrication. Every euro of government borrowing capacity consumed by defense bonds is a euro not available for green infrastructure, healthcare, or education. Every factory floor converted to artillery shell production is a factory floor not producing consumer goods, industrial equipment, or export products. During World War II, this trade-off was considered acceptable, indeed necessary, because the survival of democratic societies was genuinely at stake. Consumer goods rationing, factory conversion, and deficit spending were the price of winning the war, and that price was paid willingly by populations that understood the stakes. The 2026 situation presents a more ambiguous calculus. The threat is real. Military planners across NATO are not inventing the risk that Russia's trajectory poses to European security architecture. But the threat is also probabilistic, not immediate. European populations are being asked to make economic sacrifices to fund military capabilities designed to deter a war that has not yet been declared against them. How societies navigate that trade-off politically will shape not just defense budgets, but the entire macroeconomic environment of the coming decade. The bond market signal from mid-February 2026 is worth examining in specific terms. As reports from the Munich Security Conference circulated on February 15th and 16th, and as the 3.5% GDP spending target began appearing in financial media, sovereign bond yields moved. The 10-year bond yield, which had been trading around 2.8% in early February, rose to approximately 3.1% by mid-month. Analysts at major European banks noted that the move was consistent with markets pricing in an additional 500 to 800 billion euros of European sovereign debt issuance over the medium term. For context, the total outstanding stock of German government bonds as of 2025 was approximately 1.5 trillion euros. A 500 to 800 billion euro increase represents a 30 to 50% expansion of Germany's sovereign debt burden within a few years. French OATs, the French equivalent of German bunds, saw their spread over German debt widen slightly, reflecting concerns that French fiscal capacity was already constrained heading into this period of expanded borrowing. Italian BTPs, whose spread over German debt is closely watched as a measure of European financial stress, also widened. The ECB faced an immediate communication challenge. Its mandate is price stability, maintaining inflation close to but below 2% in the euro area. But if European governments were about to expand borrowing significantly, and if that borrowing financed spending that would increase demand across the economy, the inflationary implications were not negligible. The ECB could respond by keeping rates elevated, which would increase government debt servicing costs and potentially stress sovereign balance sheets. Or it could accommodate the fiscal expansion by easing policy, which would risk letting inflation run above target. Neither path was comfortable. Both involved trade-offs between institutional mandates and political realities. This is what fiscal dominance looks like in practice. Not a dramatic announcement that central bank independence has ended, but a gradual narrowing of the space in which independent monetary policy can operate. The historical comparison that carries the most analytical weight here is not World War II, but the period following World War I. After 1918, several European governments faced a combination of massive war debts, reparations obligations, and reconstruction costs that exceeded their fiscal capacity. The United Kingdom pursued gradual debt reduction through sustained fiscal austerity, accepting slower growth in exchange for long-term fiscal credibility. That process took decades and shaped British economic policy through most of the interwar period. Germany, facing reparations under the Treaty of Versailles on top of its own war debts, experienced hyperinflation in 1923 that effectively wiped out the real value of its obligations, but also destroyed the savings of an entire generation of middle-class Germans. The lesson from these divergent outcomes is that how a country chooses to manage its war debt burden has distributional consequences. Some approaches protect creditors at the expense of taxpayers. Others protect taxpayers at the expense of savers. None of them are painless. In 2026, European policymakers were beginning the early stages of a process that would not reach its resolution for years or decades. The bonds had not yet been issued, the defense spending had not yet been fully ramped up, but the direction was clear and the markets were already adjusting. There is one more dimension worth examining before drawing the analytical threads together. It concerns the United States. American defense spending in fiscal year 2025 was approximately $886 billion, already the largest military budget of any nation in history by a considerable margin. As a percentage of GDP, this represented roughly 3.1%, already above the NATO 2% threshold. The U.S. national debt, as of early 2026, stood at approximately $36 trillion. Annual interest payments on that debt had grown to roughly $1 trillion per year, larger than the entire defense budget of any other nation on Earth. Every additional dollar the U.S. Treasury borrows increases the annual interest burden. At current trajectory, the Congressional Budget Office projected that interest payments would consume an increasing share of federal revenues over the coming decade, crowding out discretionary spending on infrastructure, education, and scientific research. The U.S. situation illustrates the end state of the process that European governments were contemplating entering in early 2026. Defense spending funded by debt creates obligations that outlast the strategic circumstances that generated them. The United States is still paying, through its debt servicing costs, for Cold War military infrastructure built decades ago. European governments beginning a major defense borrowing cycle in 2026 will be paying for it through their national accounts well into the 2040s and 2050s. The question is not whether this is the right choice. The question is whether the populations being asked to fund it fully understand the duration and distributional consequences of what is being decided. War bonds in 1942 were sold with a clear narrative. Here is the enemy. Here is what defeating them costs. Here is how your sacrifice contributes. The 2026 version of that conversation is considerably more complicated. The enemy is ambiguous. The timeline is undefined. The cost is open-ended. And the connection between your higher mortgage payment and European security architecture is not the kind of story that fits on a bond rally poster. What is clear from the bond market data, the defense industry order books, and the fiscal projections emerging from European capitals in February 2026 is that something structural is shifting. Western governments are moving, at varying speeds and with varying levels of public acknowledgement, toward a model of military fiscal integration that resembles wartime finance without the formal declaration of war. The capital markets are pricing this in. The defense companies are building capacity to absorb it. The central banks are managing the consequences of it. And somewhere downstream in the form of mortgage rates, consumer prices, and the long-term composition of public spending, ordinary citizens are beginning to pay for it. Freedom, it turns out, does have an interest rate. And in 2026, that rate is rising.